Hi everybody. In this video, we'll finish the Chapter 7 study guide exercises that we began in our previous video. We left off on question number 4, so here's number 5. Samcom sells $50,000 of its accounts receivable and is charged a 3% fee. Prepare the appropriate journal entry. Please pause the video. Write your journal entry, then start the video again to check your work. The correct journal entry is a debit to cash for $48,500, a debit to factoring fee expense for $1,500, and a credit to accounts receivable for $50,000. The analysis behind this journal entry is as follows. If the company sold its accounts receivable, $50,000 of its accounts receivable, then it no longer owns that accounts receivable. Therefore, you have to credit accounts receivable. It doesn't own it anymore. You got to get it off the books. But the company did not receive $50,000 for those receivables. It received only 97% of the $50,000 because it had to pay a 3% fee. So $50,000 times 97% is $48,500 cash received for the receivables, and the difference is charged to an expense account. In this textbook, they call it factoring fee expense, debit factoring fee expense for $1,500. The next 4 questions relate to number 6, the scenario set in number 6. On July 6th, Celebration Company completed a large consulting project for a customer for a fee of $35,000. The customer paid $5,000 down and on that date signed a 10% 60-day note for the balance due. Write the journal entry to record this transaction. Debit cash $5,000 for the $5,000 Celebration received. Debit note receivable $30,000 and credit consulting revenue $35,000. If we knew the name of the customer, we would put note receivable dash and the customer name. But we don't know the name of the customer. Celebration Company is the company that completed the $35,000 fee, and therefore we are recording this journal entry on behalf of Celebration Company. Debit cash $5,000, debit note receivable $30,000, credit consulting revenue $35,000. Number 7. What is the due date of the note receivable shown in number 6 above? The note was signed on July 6th, and it's a 60-day note. So what you need to do is calculate the due date for that note. There are 31 days in July, minus the day on which the note was signed, July 6th, means that the note was outstanding in the month of July for 25 days. Plus all of August, there are 31 days in August, and then check to see how close you are to 60 days. 31 plus 25 equals 56 days, which means that there's still a little bit of time to go before the 60 days are up. So we're going to go into September, and we need 4 more days to make up 60 days. 25 in July, plus 31 in August, plus 4 in September, equals the 60 days in this note. So the due date of the note is September 4th. Now let's assume that Celebration Company is a corporation with a July 31st year end. write the journal entry to accrue interest receivable and interest revenue on July 31st. Remember from way back in Chapter 3 and also in your study of Chapter 7 that interest is calculated as principal times rate times time, PRT. The principal is $30,000. Yes, we charged the company $35,000, but they gave us cash right away. So the amount of the note, the principal amount of the note is $30,000. So principal is $30,000 times the simple annual interest rate of 10% times the number of days outstanding in the month of July, and that was 25 days, divided by the number of days in the entire year. And remember that bankers think there are only 360 days in a year. So the formula is $30,000 times 10% times 25 divided by 360, and that equals $208 of interest receivable and interest revenue that has been earned in the month of July. Now, on the due date, which up here we calculated as September 4th, Celebration Company received full payment on the note created in number 6 above. That's the $30,000 note. Write the journal entry to record receipt of the principal and interest, and hint, don't forget that we already accrued $208 worth of interest receivable on July 31st. There are 2 periods of time that we need to be concerned about. The first is the month of July, because that takes place in the year that ended July 31st. And we earned $208 of revenue in that time period. The second time period is what happened beginning August 1st, which is the first day of the new year. And we need to record the revenue that was earned in August and September in the new year. So we need to do some calculations. There are a couple of ways this calculation could be done. The first way is I said, okay, well, let's figure out the full amount of interest that is due on this note. And remember that it is a $30,000 note with 10% simple annual interest for a 60-day period. So the full amount of interest to be received on this note is $30,000 times 10% times 60 divided by 360, and that equals $500. So from the customer's point of view, they don't care when we record that interest income. They just know that they have to pay us the $30,000 plus the $500 of interest. It's up to us to record this $500 of interest in the correct time period, and we already recorded 208 of it in the time period that ended July 31st, which means of the $500, 208 already recorded, $292 of interest income then was earned between August 1st and September 4th. An alternative calculation is principal times rate times time, where $30,000 is the principal, that's the same. Interest is the same. The time, we could say, okay, well, how many days are in the new year? August has 31, and payment was received on September 4th. 31 plus 4 is 35 days in the new year. We already recorded the interest income for this 25 days. 35 days in the new year. So principal times rate times 35 divided by 360 equals 292. It's the same amount of money, either calculation. So the correct journal entry then is to debit cash for $30,500. That's the $30,000 of note that was due from the customer plus all of the interest. $500 worth of interest. Then we need to credit. Notice up here we have interest receivable. We got paid for that. So we need to credit interest receivable for $208. Credit interest revenue for the new time period's worth of interest. Notice that these two credit amounts to interest revenue here, equal $500. And then credit the note receivable, $30,000. Well, that's all for the Chapter 7 study guide. I'll see you next time for Chapter 8.